Thank you. All right, folks. Welcome back. Welcome back. All right, today we're going to talk about, well, it's going to be the introduction into working with small accounts. Some of you that have been trading for a while probably don't have that problem. You probably have a little bit more money than some that just start out in this industry. But because my aim is for the first 3 months to kind of like target folks that have just now entered into the foreign exchange market or have struggled and never really seen their money grow, their chances are they're going to have a very small account. In fact, if you don't really know what you're doing trading-wise, it's actually better for you to start out initially, even after you've done work in a demo account 6 to 12 months in length. The best avenue you can do is go with a very small shoestring budget because the shock of having financial attachment to the trades is going to be something for you to get used to. Like I did with my first teaching series back in 2010, what every new end or aspiring forex trader wants to know, I kind of like brought to light, at least in my attempts, to draw more attention to the fact that there's so much opportunity doing very little in this industry that folks get caught up in the Lamborghini, the mansions, the high lifestyle, the baller mentality. And quite honestly, there's very few people that actually live like that, not through trading. Okay, let's just say it that way. Most do it through things like what I'm doing now, obviously through a paid mentorship because it's very lucrative to do something like this. But to be able to make money and generate it and compound it, that's something that very few traders actually can do. One of two things happens. One, they quickly realize they don't know how to trade and they self-destruct, or they do have a modest ability to turn a profit, but what happens is they see the money and they get greedy. Now, if you've paid attention, the first month of this mentorship was specifically aimed at removing your fear of missing opportunities. Almost on a daily basis, with the exception of two occasions, we saw everything that we outlined in terms of probable movement come to fruition, almost to the pip. There was a couple times it robbed me by one pip. It didn't get right to my targets, but nonetheless, there's opportunities every single day. Now, it's not my aim to instill that desire to trade every single day. But as a developing trader, you should be doing something in the marketplace in your demo account to build up your experience, build up your, your skill set. And it's not important that you see positive results because you're going to learn more from the negative things because it'll draw a highlight and a spotlight to where your weaknesses are. And you want to figure out what those are when you're outside the scope of risking live funds, because all that's going to do is compound and exasperate the problems. Okay, and what you'll do is you'll go into denial. Trading with live funds forces the trader, whether they're male or female, and more so with the men, you'll put a band-aid, okay, or blinders on a gaping wound in your problem of not being consistent or not even knowing how to trade. So this entire month is going to be aimed at, number one, building the idea of starting with a small account. And then the second half of the month, we'll be working with aiming for 10% per month. So I'm actually going to give you the foundations to how to double your money every single year with the methods that I'm going to teach throughout this week. So every day we meet this week, there's going to be 5 sessions, and it's going to be aimed at building a trading model that aims at 6% per month. Now, there's some of you are probably saying, well, wait a minute, I'm paying good money for this now. I'm not really interested in 6%. I already know what you're thinking. Okay, trust me, just roll with me for the first week. Okay, the second week of the month, we'll get a little bit more higher up in terms of potential returns per month. But by the end of this month, you will have everything you need to go into the marketplace realistically and have all of the potential to consistently draw out 6% per month. Now, again, for some of you are new, it doesn't sound like much. It doesn't sound like I'm going to get rich real quick. And that's exactly what you need to be thinking right now. You need to be thinking, I'm not going to get rich real quick. Okay, I need to be consistent. You start with bread and butter consistency. Nobody out there goes from neophyte to super ultra rich, George Soros, Warren Buffett. It doesn't happen. That does not happen. There's a lot of growing. There's a lot of learning. There's a lot of losses between where you start and where you end up at. So I want you to think about all the opportunities we saw for the first month. Okay, and they are all very short-term trading opportunities, very, very short-term intraday. You don't need a whole lot of trades. You only need really one of those per week. One, just one. Now I'm going to give you an example here. Okay, and obviously some of you probably have a lot more money than this, and I'm not trying to, make light of anybody else either, but the average, in my opinion, I think if someone's going to start out after they've done the work with the mentorship, I think they should test the waters with an account of about $1,000. So at the end of 12 months, then and only then, in my opinion, I think if you've gone through everything we teach, then you would consider, I'm not telling you to do it, but you would consider doing what you've learned in a demo account if you've been consistent and you've adopted a mindset that you continuously do the same thing over and over again, and it's giving you a positive result. It doesn't mean you're going to be perfect in your trades or not taking losses. It just means that you're going to be consistently profitable on the net. Well, 6%, if you start with $1,000, we're going to say the first week to make the compounded 6% return for the month. It's actually a little bit over 6%, but you only need the first week here. You only need to make $15. Now, it doesn't sound exciting. It doesn't get you all worked up in a froth. It doesn't get you thinking, well, I'm going to quit my job, okay, because some of you have that mindset that you're going to replace your job or the necessity for a job in 6 months of this mentorship. That's not realistic, okay? So having this mindset going in as a new trader or someone that has not been consistently profitable, $15 return on 1 week does not get anyone terribly excited. It's 1.5% return. So 1.5% return, if you do that for 4 weeks, it's a little bit over 6% a month. At the end of the month, you're only going to have $1,061.36, or roughly within earshot of those pennies over here talking about. That, again, that does not get anybody terribly excited. But I can tell you this. If you can do this percent return just 8 months out of a year, 6 months out of a year, okay, you need to stop and think for a moment. Think outside your current conditions, okay, or your current limitations, because really you're only limited by your perspective right now. You're actually in a prison in your mind thinking that you have to break out right now and you got to get out of your job, when in fact you need to stay in your job right now, and you need to stay because that's guaranteed income. When I first started, okay, I had a job. I did not quit my job until I had $832,000. Then I didn't work. All the while I was making money, I did not think about leaving my job. My goal was quitting work at 40 years old. I was in the beginnings of my 20s thinking this. So if you were able to sit down with every extremely profitable trader, well-balanced in their psychology, well-balanced in their risk management, okay, and their expectations, they all have a secondary source of incomes, because if you try to start with this industry as your sole income, number one, you're going to force yourself to do things you shouldn't be doing. You're going to trade more often than you should, because the necessity of making money is going to supersede the process of trading in a balanced and objective way. Too many times I've spoken to folks that have really, they know how to trade. They absolutely know how to trade, but the psychological aspects of having to make money forces them to do things that they shouldn't be doing. So if you have a job right now, and I know you probably want to get out of it right now, and that's understandable. I couldn't wait to get out of my job. I was dying to get out of it. But even though I was consistently making money early on, all by luck, okay, all by luck, but nonetheless, I was not in a hurry to leave my job because I knew that this money was coming in every single week, whether I was making a trade or not. So if you are contemplating replacing your job, you have to do that in a graduated scale. Don't think that you can't be completely financially independent within 24 months after this mentorship, because I'm telling you, if you do the things I'm telling you to do and just relax and allow this 6% thing here, I'm telling you, there are so many people out there with tons of money that are ignorant with their money. They have no idea what to do with it. If you approach them with the means of being able to do this just half of a year, 6% compounded just on 6 months of trading, You don't need to trade during the holiday months, the dog days of the summer. You don't need to do anything like that. And trade their money, other people's money. You're going to manage other people's money. Okay, and maybe you don't want to do that. But I'm just giving you horizons that are a little bit broader than you're probably thinking right now, because if you have just a very small shoestring budget, but you learn how to trade, people will throw money at you. They're going to throw money at your feet and say, please do something with this. They're going to beg you, and they'll be offended if you say no, because they know that you know what to do with it. So if you take these insights and apply them to consistently small trades of taking on small risk, but compounding that small risk, okay, into profitability over the course of a year, if you show somebody over 35, 40% return in a year, believe me, they are your best friend, and they're going to tell everybody about you, and you're going to draw them up more business than you can handle. If you take on other people's funds, and if you can do this, and I'm not trying to talk you into it, but I'm just giving you a different perspective, because it's an easy way to fund your own trading with a great deal of money once you understand what you're doing. It's easy to get $100,000 dropped in your lap, okay? It's very easy to get management fees, okay, that'll put you over $250,000 in a year, and you don't have to do much to do that. So don't think that this mentorship and this specific teaching today, or even this entire teaching for the entire week, doesn't fit you, because I'm telling you, if you think about the things I'm going to share with you, it broadens your horizons. And you don't have to be a fund manager. You don't have to manage other people's money, okay? But it's an avenue for you if you don't make much money, okay? Say you're a single mom. Say you're a single father, and you only have one income, and you're just struggling. You got to get out of where you're at. Use these concepts, okay, and in the abilities of marketing yourself later on as a fund manager, which you'll learn in the later parts of this mentorship, that will give you an unlimited amount of funds that will be attracted to you. Because once you put yourself out there, believe me, people will come to you. And it's going to be up to you how much money you take on. But you don't need a lot of money of other people's funds to do very well. Once you fund yourself, you can go into a limited partnership. Say, hey, look, I'm only going to do this for 36 months. Okay, and this is our agreement. And I'll give you all those details later on in the mentorship. But it'll allow you to fund yourself. See, some of you can't just easily go out there and say, okay, well, I'm going to plunk down $100,000 and I'm going to start trading. Because personally, for you to quit your job, I personally believe that you need 2.5 years of living expenses plus $100,000 to trade with. If you can't do that, you should not be trading for a living. And it's as simple as that. Because you got 2.5 years of cushion. You're not going to be impulsive about getting in the marketplace to trade, because you have 2.5 years of cushion. You're going to have periods where the 1 or 2 months of the year, you're going to have a drawdown. You're not going to do very well. It's realistic to think that way. You need to plan ahead for that. But don't negate the value of starting small as a new trader, looking at 6% compounded return. Because I guarantee you, you ask anybody that you know of, come in contact with them this entire week, the people you work with, your family members. You don't have to go into detail about what you're talking about in terms of how you would get that 6%, but just ask them, hey, can you imagine if you got 6% on your money every single month? What would that do for you? First of all, they'd be like, well, that's pretty good. That's better than a bank. Well, it's way better than a bank. But then if you tell them, look, hey, if I took $1,000 of your money and I gave you $61 at the end of the month, would you be excited about that? They'd be like, well, no way, man. Get out of here. I'm not going to give you $1,000 for that. But the problem with that thinking is, and this is the reason why everybody else, at least in the U.S. and majority around the world, this is millionaire making. This is affluent lifestyle creation at its core. It's the absolute thing that everybody wants to know, but they won't listen to it when it's being taught to them. Because $61 over the course of 4 weeks, it's not exciting. It doesn't equate to I'm going to get rich. It doesn't equate to I'm going to replace my job. But that same amount of money started and compounded over the course of 1 year becomes over $2,000. Now you tell someone, say, hey, look, if you give me $1,000, I'll double it in a year. Suddenly their perspectives changed, but it's the same thing. Nothing's changed except for the delivery and the information. And it comes by way of ignorance, especially in the States. Our education system promotes this idea of slave mentality, get a good job and work for the man. And I can't stand it. I cannot stand it. I wish that there was a way. And here's the thing, even if you learn this and you want to try to do it, because believe me, I've tried to do this. I've tried to work my way into local schools to do like an assembly, to teach children, okay, coming into the ninth grade. If I would have learned these skills and ideas about money in the ninth grade, I would completely be on a totally different level financially. I'd be well ahead of where I'm at now. My children are learning these things, and you need to teach your kids this stuff too, not just trading, but you need to understand that managing money, okay, it's a tool, it's a resource, but we're taught to be a slave to it. It's a taskmaster to us. We go to work for what? Money. Well, I don't work for money. I put money to work. And by having this mindset, that same over this, look at the numbers. It's the same thing you see over here. Nothing's changed. It's the same dynamic. But this is just on a monthly basis. You start with $1,000 in the first month, it's $60. Then it's 2 months, it's $1,123. It's not exciting. But over the course of a year, you're doubling it. So now you say to these investors, okay, say, look, I have a track record. Okay, for 24 months, I've been consistently doing minimum 6% return, at least the majority of the year. I guarantee you, you're going to have hundreds of thousands of dollars laid at your feet if you can show a consistent track record. Not just, you know, here's a demo account. That's not what they want to see. They want to see that you can obviously manage it with live funds, okay, and you will work your way into larger fund management. Easy to get $1 million into your hands doing that. And believe me, you give somebody a $100,000 account and you double it in a year, they're going to talk about you. And they're going to say, hey, look, you know, I got somebody else I was talking to and they went in. Because think about how you feel when you first started learning these things and then you start seeing it in your charts. If you went through my free tutorials, you've watched some of these things occur in your charts and you can't believe how it worked. And you start telling your friends, you telling your spouse, and you get excited. Well, that same thing's going to happen when you talk to someone else about when they talk about what you've done with their money. They're going to feel like they did it themselves and they're going to brag about it. That's what people do. And it's going to be word of mouth advertisement. And then you're going to have so many opportunities for people to throw their money at you. It's up to you how much you manage, but you can use that as a means of funding yourself and putting yourself in business. And then you don't have to manage anybody else's money. That's what I did. I started, I had immediate success. Then I realized I couldn't trade. I had to learn how to trade. And then when I got relatively decent at trading, I dabbled in other people's money. And then I got into a very fortunate situation where I traded a large conglomerate's money in Baltimore. And long and short of it is that padded me out considerably, a lot, because they're a Greek family and they were afraid that if they didn't pay me well, I would stop doing it. So everything that I asked for in terms of the terms, they went over that. Now, maybe that's a very fortunate and far and few between type of opportunity, and maybe that won't be for you. But I can tell you from personal experience, when you do well for somebody, they're absolutely going to talk about what you did for them. And they're going to put this opportunity right in your lap. And when you have this, it's easy to generate money. Very easy. But here's the thing. You have to have the mindset and understand the appreciation of this something so simple as this over here. That's what everybody wants. Everybody wants out of their job. I don't care what they are, doctors, lawyers, all that stuff. They're doing these things to make a lot of money because they want to live well in retirement. I want to live well now. I want to do it right now because there's no guarantee I'm going to be old and healthy enough to enjoy money later on if I have it in a 401k. That's just the worst perspective on life there ever could be. You need to have your mindset now that you can easily, very quickly, in 10 years' time, if you take these numbers, okay, if you pull out a calculator, if you have a smartphone, pull out your calculator, put $1,000 in there, okay, and then multiply it by 1.06 and hit that equal sign 12 times, and you'll arrive at this number down here, okay, and continuously do that until you arrive at 10 years. Now, obviously, we're not talking about taxation and the effects of that, but it's over $1 million in 10 years. My question to you is this. If you're not going to think about money like this, okay, where else are you going to get $1 million in 10 years off of $1,000 investment? It's just not going to happen for you. It doesn't happen unless you're going to hit the lottery, and lotteries don't usually take 10 years to pay out. It's usually you win or you don't. So the idea of looking at the marketplace like this, it is an absolute bastion of free enterprise that is untapped in terms of its limitlessness. It's crazy what you can do with it, but the problem is everyone wants to start out with $100, okay, and turn into a $10,000 account in 6 weeks, and that cannot happen. It doesn't happen. It will not happen for you. As well as I know how to trade, I still can't do that. So I'm telling you, don't think that way. If you think like this, just for the first month, and you can just repeat that every single month, you end up at the end of the year doubling your money. If you just worked your job and took whatever money you saved, okay, over the course of a year, take a budget yourself. Say, look, I have paid TV every month. I'm going to focus on studying. I'm going to take the paid TV out, and I'm going to just focus on taking that money and saving it. And if I save that money over the course of a year, I will double what I would have spent in a utility bill. I'll double that in the course of a year. And if you start looking at life like that, you will quickly see how easy it is to sell yourself to someone else when you know how to trade. Because you can tell them, hey, look, I don't need a lot of your money, but just consider it. And then once you show them what you can do with your own funds, it's unbelievable how fast people start talking about you. They want to give you their money, and then you manage it, and then you get all kinds of incentives. You get 2% management fee, and you get a performance incentive. So once you get to that level of understanding how to trade, don't think that you're so far behind the 8 ball that you don't have the funds to trade to get yourself out of where you're at, because that can all change in 2 years. 24 months can absolutely change the entire landscape of your entire existence. Everything changes. Because if you have $100,000, if you do these same things, you're making $100,000 a year. Do you make $100,000 a year at your job? Some of you in my voice earshot could probably say, yeah, I do that. I make more than that. Some of you in here own businesses. Some of you have businesses, okay, and you probably earn more than that. But majority of you don't. You don't. So if you can get yourself in 24 months from now, the ability to have someone else fund you that level of initial capital, who cares what you have right now to start with? It may be even less than $1,000 right now. Who cares? It's not important. All it does is it makes it a little bit longer for you to get to that end game. But don't change your perspective on you need to have it right now, because you don't. Because take trading out of the equation. What would you do if you didn't have trading? What would you do? You go to work. You do the same thing you're doing now. You would just be miserable with no hope. There's absolutely hope. Okay, there's so many things for you to do very well with this, and you don't have to do a lot. So now, what does it take to do this? Obviously I'm pitching you like I'm trying to sell you a timeshare here, but the idea is important for you to understand that low-hanging fruit is the easiest thing to get. And that's all you would need to sell yourself to someone else to manage their funds, and you would be absolutely blowing their socks off. To get 1.5%, think about what would be necessary. If you had a $1,000 account and you need to make 1.5% return for the week, what would be some of the parameters that would frame a return like that? What would you require in terms of a trade idea to pay out 1.5%? I guess I should probably open up this little question tag, because maybe some of you have some good feedback. Okay, so if you have $1,000, okay, it's your equity, and you're aiming for 1.5% return for the week. Okay. So obviously, if you're going to do gearing of leverage 1-to-1, in other words, you're going to risk $15 to make $15. Now, right away, let's be realistic now. You're a new trader. Now, some of you probably aren't, but I'm speaking to those in here that are. You have 1-to-1 risk to reward. In other words, you're going to put up $15 in a trade idea in attempts to hopefully make the $15 return. That gearing is 1-to-1. You have to be terribly accurate to do that very consistently. Now, as a new trader, my question is this: do you feel confident as a new trader that you can consistently find a trade risking 1-to-1 every single week to make that 1.5%? Only 2 people's answered so far. Okay, now everybody's hearing me now. And I'm in a lot of no's, and I appreciate that. The idea is you need to figure out, obviously, what you're aiming for. If you don't have a target, you're going to hit it every time. If you aim at nothing, guaranteed you're hitting that target every single time, because it's easy to do that. But you have to know what it is specifically you're looking for. So I'm going to give you some ideas, okay? If you want to make 1.5%, there's a couple different ways. There's a lot of different ways, but there's a couple that come to mind. You can do a 30 pip objective for a trade with a 15 pip stop. That's 2 to 1, reward to risk. So you're going to risk 1 to make 2. So in other words, the situation would be this. If you can find a trade that pays out 30 pips and frame the trade where it allows you to risk a stop of 15 pips, you can trade with 50 cents, 50 cents per pip and get that on a 2 to 1. Do you understand what I mean by that? Okay, good. What if you can't be in the charts? Say you can't be in the charts and you can't be watching 5-minute and 15-minute charts. What if you were forced to look at an hourly chart like we have here? Could this same principle be used here? I got one no. I'm not going to say your name, but you know who you are. Why would you say that? Why would you say no, that it couldn't be done on an hourly chart? Entry is not difficult. It's the same techniques and concepts that's applied to a different time frame. I'm going to give you, trust me, I'm not just going to talk about it. I'm going to actually show you some examples here. So now, if we were looking at an hourly chart, now again, this can be applied to 5-minute charts if you want to be day trading, intraday sessions. You can apply this to day trading where a 15-minute chart is applicable, 1-hour chart is applicable. You can do it as one-shot, one-kill setups where you're using a 4-hour chart, trading the weekly range. You can do short-term trading to swing trading on a daily chart. Okay, what would be wrong with looking for a trade that potentially pays out 100 pips on a 4-hour chart with a stop of 25 pips? Could you frame the idea of making 1.5% on a trade idea like that, aiming for 100 pips and risking 25 pips? And that's exactly what everybody would be looking for. You're getting 4 to 1 gearing on your trades. If you were looking at a daily chart, what would be wrong with taking on a trade that paid out 400 pips but risking 100 pips? It's the same gearing, right? You're hoping to make 4 to 1 risk. So now let's go back for a second, okay? If we were thinking about framing our trade, and our approach, our business model is, because here's the camps that exist in the thought processes behind trading. There are folks out there that don't know what they're doing. They don't make money, okay? They are all pretend, they're online, and they have this online persona. They think they know something, and because they know nothing, they get online, they pretend. It makes them feel better about themselves. What they tell you is you should not have weekly goals. You should not have weekly percentage return goals. You should not have dollar goals. And I'm going to tell you what business out there doesn't have forecasts and goals in what they hope to make. Every business out there, every single business out there has sales projections. Am I right or wrong? So when you listen to someone, okay, after this teaching today, if you ever hear anyone tell you you should not look for making certain amount of pips per week. Because I caught a lot of flack from people over there in baby pips back in 2010. These same goobers are still over there, and they still can't trade themselves out of a wet paper bag. The idea of knowing what to look for gives you that ability. If you understand what the market's telling you at any given time frame, you'll know exactly what it is that's available to you. For instance, we're going to look at an hourly chart, okay? Now I want you to be honest, okay? And you tell me if this is not what we have already talked about just in the first month already. And if you've been through my free tutorials, you'll see a lot of this stuff. Okay? So if we look at price and we see price make a willingness to move away here. Now this move here isn't justified, okay? In other words, we don't look for a long until the move away from this low takes out a significant high. This high being a significant high, do you understand why this high here would be significant? To the left of this low. So when price goes up here, does this high break this high to the left of it? No. So you have to wait. So the market has a little bit of retracement, and then what happens? It expands up. Then it trades through this high, right here on this candle. So now we have, what did we learn about in the first month? What's this called? Impulse swing. Okay, impulse swing. So, and again, I'm not trying to teach optimal trade entry with Fibonacci, but I just want you to understand in the scope of discount and premium, we have the low here. This high can't be used because it didn't break this previous high over here. We can use this high here. So when it gets to that high here, we can now look and see equilibrium is down here. When price gets below equilibrium, we're at a discount, and it goes right into what is this? I'm looking for a specific, it's a pattern I'm looking for, actually, I'm asking for. What's this over here? Turtle soup. Turtle soup is a false break below an old low. Okay, so we have a couple things going on here. The market rallies up, and we would not be able to see any trade here because it doesn't go much below the equilibrium price point relative to this low up to this high. So when price trades through that, we're watching this candle, this candle, this candle, this candle, and it never gets back down below this low. But then watch what happens. It trades higher here. And then the next candle, it trades higher here. You see that? So as price was trading forward, in other words, let's look at it like this. Initially, you'd have it set up like this. And every new candle that forms, we're watching to see if it drops down below equilibrium relative to the low up to the higher high that broke market structure over here. I'm getting ready to explain that, Matt. I'm just trying to show you, because you wouldn't see that high yet. The question is why wouldn't I use that next high? I want you to understand that you wouldn't know that high's there until it forms, right? I mean, right here, you don't see it, do you? Okay, so every new candle, you're monitoring. Now, what happens here? We have a higher high. We clear out the high here, here, and this short-term high here. So now we have to do what? Anchor our fib on that new high. And then the next candle, it creates a smaller, shorter-term high. But it doesn't trade down until at the close of that day, or this hour candle. So there's your swing from low up to high. And as the market creates these higher highs, you're watching to see if it trades back down below equilibrium. Because do we buy at a premium or above equilibrium? Not for low risk and high probability, we don't know. So we're looking for discount. We frame discount with monitoring where equilibrium would be. Price has to trade below that. And if we can couple the idea of being in discount with ideas of institutional order flow, meaning if we think this is an impulse price swing, which by all indications, it suggests that it is because it took out a swing high here. We broke through it. Looking at near-term price action, this looks weak. It looks bearish. But you have what resting below these lows here? What resides below that low? What kind of stops now? Some of you are saying buy stops. What kind of stops is it? If you're long, think someone's long here. They've been making money. They're going to trail their stop loss below this low. If you're long, what kind of stop do you use to protect it? A sell stop. So sell stops are below this low. Now think about the context of what's being framed here. You have a market that has an impulse price swing higher. It has retraced, and it went down below a previous low. That's like a loaded deal. It's like that's a gift because you're seeing the market come down to take out individuals that already are in the marketplace long. So why would they allow price to go below this low? To activate those sell stops to generate what kind of liquidity? Hold your question, Arun. If they allow the marketplace below this low, it forces an injection of liquidity in the marketplace for the smart money to do what as a counterparty? It forces selling liquidity for their new buying. You understand that? Does anybody not understand that? Because it's going to be really fruitless for me to continue if you don't know that. Okay. As the market trades higher, our understanding is that someone is in that marketplace bullish. The market usually leaves a low intact and then eventually comes back and runs out that low. If we have the idea that the market should be higher because we've seen this short-term high broken on the upside, so this is an impulse swing. The market has shown a willingness to go up. If it comes back down below a short-term low, if it goes below that, our understanding is there's sell stops below this low in the form of those that are long that want to make money. They have their sell stop right below that low because that's what the books and everybody else teaches, that that's where their stops should be. If they have their stops there, it's not going to be one or two traders doing that. It's going to be everybody looks at an hourly chart that's long. They're going to see this as, okay, well, this is a big engulfing candle. I have a real good safe opportunity to place my stop loss below that low. And it's going to be a sell stop because a long position is protected when the market trades below a specific level that you have as a threshold where you don't want to see any more incurred loss. That's where you put your sell stop at. So if it trades down below this low, everybody that would have a sell stop below that low would force sell stops become market orders to sell at market. And market makers will use that liquidity that's just injected in the marketplace to buy it. They'll buy what the willing participants want to sell out of their long positions. There's going to be a huge rush to sell. So what happens is when that market drops down here like this, it's called pairing of orders, P-A-I-R-I-N-G, pairing of orders. It forces liquidity for smart money buying. See, smart money needs to have counterparties to sell to them because smart money by nature are sellers. They're providers of liquidity. So they have to force people to put sell stops in the marketplace below lows, and that way they can get liquidity counterparties for their buying. Does that make more sense now, Mel? Okay. So now if we see that we have an impulse price swing higher, the market trades below a low here, and on top of that, we're also inside of a deep discount or optimal trade entry. Okay. What else is going on right here? As price hits this low, and it's probably not that clear to see, but I'm just going to put a little rectangle here highlighting the fact that we're in what would be considered 62 to 79% retracement in here. And I'm going to take the fib off so we can see a little bit better. So as it hits this area here, what are we doing? We're taking out an area of stops. Okay. And then what's going on also in here? Very good. Very good. What's this candle right here? What's this candle? Bullish order block. What makes this down black candle bullish? It's the last candle before the low, before the price swing higher forms. We understand that this is exactly where the most sensitive price point for buying is going to be. Now, is it going to be the wick? Is it going to be the opening of that candle? Is it going to be the middle of that candle? Is it going to be the low of the candle? What's the most sensitive price point? What do you see most of on this candle? Is it a lot of body, or is it a lot of wick? The body, right? So we have more beefiness to the candle in the body. So we're going to elect to use the opening price, but we'll permit sensitivity as to what price level on this candle. If it's not just the opening price, where are we going to go to next? Okay, let me ask you this way. If we identify the opening price, that's where we highlight the most sensitivity, okay? Now that's the key word, the most sensitivity. That sensitivity can begin as early as what? The high of the candle, right? Now, do we want to see the middle of the candle traded to? If it's a high probability trade, do we want the middle of that candle traded to? No, exactly. So you don't want sensitivity, okay, or the willingness to want to see price go down to that middle candle as much as you possibly can, because that's the least favorable condition. You want to see sensitivity or support. In this case, you want to see price find support at the body's candle or opening on a down candle and as early as the high. So in here, between the wick's high and the body of the candle, that's where the most sensitivity should occur. But we allow how much of a move into that down candle? 50% of the candle. And what does that mean? Mean threshold, right? So if we see the candle trade down through the middle of the candle and it closes, what does that mean for your trade idea? Do you wait for your full stop to hit? What can you do? Exactly. You can either take some of the trade off if you still feel convicted about it, or collapse the trade and move on to a next high probability trade. Very good, very good. So this is where the sensitivity begins, right at the opening price on this down candle. I'm going to eyeball the middle, right about there. So from the opening of that candle to the close of that candle, again, when we use the mean threshold, we are not counting the wick. It's really, really, really important. Do not look at the middle of the candle from the high to the low. The wicks are going to throw you off. You want to look at the body of the candle and divide that in half. Extend that out in time. That's where sensitivity should be. Why is the middle of the candle the last threshold? What's going on at that level right there? I'm not sure if I actually taught this or not, but I don't know if I did, but I don't know if you answered. Jonathan says, no freaking idea. Well, how do we get price delivered to us? By way of the algo. The interbank algo, the price delivery mechanism that feeds us our pricing, okay? Is price random? No way. So if we can see the impulse price swing here, it's going higher. If they come down below a low and the overall price model is still bullish because we see market structure break here, we go back to an area at which the algo is going to know by reference. Now, everyone's wick is going to be different on your candle, just for study purposes. For everyone that is watching this, do it in your recording, not now. Just pay attention if you're listening to it live here. What you're going to do is you're going to look at your candle on September 26, 2016, whatever this candle is representative of your time. This would be, what would that be? Midnight's 4, 1 is 5, 2 is, it's 3 o'clock in the morning, New York time. September 26th. Find out what your low is, 129.24, and your high for that candle, 129.52. And I guarantee you your candle is going to have different highs and lows. But the middle of the body of the candle, the bulk of that body, that's going to be the closest representation of the central bank's price delivery. Okay, it's going to be the closest thing that you're going to get. It's still not going to be absolute. It's still not going to be perfect. But this is the bridge I made between what I learned about how price is delivered to us and seeing it in our own charts. So the epiphany I had was this thing occurs like on a 90+% basis. So if you know where the majority of the momentum is going to be, or the next price leg is going to be higher or lower, all you have to do is find that down candle. If you're bullish, divide that in half, and anything above that point up, you should be focusing on buying. Now, here's the thing. Here's the wonderful thing about this. Say you are a trader that cannot, say you can't be in front of the charts all the time, okay? Can you, between, I don't know, maybe 7 o'clock in the morning, 9 o'clock in the morning, New York, can you periodically check your phone and take literally 10 seconds to see where price is on British Pound USD? Regardless of what you're doing, if you're working a job or whatever, can you take 10 to 15 seconds to see where price is between 7 o'clock and 9 o'clock in the morning? Just periodically look. I mean, if you get text from your wife or your husband, I mean, you're doing the same thing. Well, maybe not so much the husband. You're probably not. If you're like me, I get in trouble all the time for not answering my wife's text. But the idea of being able to look at the market, you have to be able to see it. Okay, you have to be able to reference it, and there's specific times of the day that you need to be able to do that. So some platforms allow us to have alerts. Now, I'm not a real big fan of alerts because I'm actually really conscious of what price is doing specific times of the day. But if you have jobs or businesses, then you can obviously set these alerts if you see price trade below this low here, okay? Or how about this? We knew with the Fibonacci equilibrium level was relative to this high. So once this high forms here, once this high forms in the trade, you see that it's trading lower, all you have to do is do what? You can see what equilibrium is, whatever that price point is, and all you got to do is get a reference point like this. Okay, so now you have alert. Set an alert for price to alert you if it gets below 129.60. If price goes below 129.60 on British Pound USD, your phone or your device will email you or send you a text message and say, hey, British Pound is below 129.60. So what does that mean? Go to your charts. Go to your charts and say, okay, well, it's trading down here. It's gone below that level of equilibrium, okay? And these are hourly candles. And you can do this on a 4-hour or daily basis. It doesn't matter. But there's no reason why none of you can't do these types of things, because there's so many things in technology that allows you to be alerted. You don't have to stare at charts all day long. Once you understand what it is you're looking for, you can set these little things up to alert you. But because I'm a nut and I want to be in the marketplace studying all the time, even if I'm not taking live trades, I'm always available. I mean, you guys can see it. When I'm clicking charts and sending them to you, I'm getting it right when it hits the order block. I'm sending it right to you when it's happening the level I call for. I'm there all the time. I'm seeing it. I'm not out there waxing cars and filling gas tanks. I mean, I'm doing chart study. So looking at price, when price goes down below this low here, right below this low, we know that we are in an area at which, yeah, I know, I have a trader's life. That's the kind of life I have. I guess you can say that. A trader's life is no life until you're actually on vacation. But the low here, when we trade below that, we know that we have potential to run out to sell stops, which is going to inject selling liquidity for buying for smart money. And here's the middle of that down candle. So now, what's the idea over here? When we see price trade down here, what can we do with this? You can do, what's the pricing over here? What price levels are we looking at? What level is this? Right over here. What level is that? It's a 50 level. That's highly sensitive. Big, big, big defensive level. So we have an institutional mid-figure. Okay, it's a 50 level. So there's going to be sensitivity around that price level. especially the fact that there was a previous low there. If we see price come down below a previous low and it's at a mid figure or a round big figure number, in other words, it's 130.00 or 129.00, they're big figure numbers. If you see a low or a high violated around that level, many times that's a turtle soup. That's something you can put in your notepads and start studying the rest of the week too. But for here, we have a loaded deal where we have a low violated here with the impulse price leg moving higher. We're at an order block here. So the idea is we could be buying on a limit order at 129.50. Okay, 129.50. Our stop is defined by the mean threshold, 129.34. So we can go about 10 or 15 pips below that. So in that case, what would we be looking at? What price level would we be using if this was the data provider you're actually trading on, this was your platform, and the mean threshold comes in at 129.34, we want to go 15 pips below that. What would our stop be? Roughly 129.20. Okay, so 129.20 defines our risk. There's your stop. Now here's the problem. Okay, folks see these types of trading things in books and such, and they'll say, okay, here's a swing low, and maybe this is a retracement. They're going to put their stop loss where? Everybody else out there in trading, where's their stop loss going to be? Under this low, right? And it's going to be what? 10 or 20 pips below that low. Isn't that what you all learned? Put your stop below old low, 10 to 20 pips below it, because it's protected under there. When we've been teaching that the stop runs go 10 to 20 pips in grade. So my question to you is this. Is this a bad idea, putting a stop loss up here above the low? Why? Why is this not a bad idea? This is important. Why is it not a bad idea? Multiple reasons, but specifically why? Number one, it preserves equity. It has a lower stop at risk. It allows you to trade with more leverage defined by your risk parameters. Okay, we're going to assume a risk of 1.5%. Okay, but here's the thought process. If this market trades down below the mean threshold, say it does that, say it trades down here and it goes to 129.20, is it likely to stop at 129 and go back up and make you feel like an idiot? It can always do that, but I'm saying in terms of probability, if this market trades down through there and hits 129.20, think about what we got over here. Is it going to go down to 129.20, stop there, and go back up 190 pips? No, it's going to do what? If it goes down to 129.20, it's most likely going to do what with these lows? It's going to blow through them. So my question is this. If we see a trade idea that's framed and we can see the mean threshold where institutional support should be found, the algo should not deliver price much lower than 129.34. It can touch it because there's going to be a deviation from what the interbank data feeds are with the price engines when they deliver price. That interbank pricing is going to be slightly different than what we see in our platforms, and you have to allow that. If you're going to be nuts about, it has to be this or it has to be that, you're going to lose money, or you're going to lose your mind. You're going to force things that can't happen for you in terms of consistency. But you can trade in this gray area where we can see where the probabilities are stacked in our favor. We can define our risk and have our stop higher than what would be otherwise placed with other traders. By having a smaller stop relative to where the old low is, we can use more leverage. Now, it doesn't mean we're incurring a larger risk. We're just making a stop frame around a smaller stop loss. Do you understand that before I go further? Does anyone not understand what I just said? Okay. So now, if we are going to be a buyer at 129.50 on a limit, our stop's at 129.20. What is our total pips at risk? Okay. Now, here's the question for you. If we have framed the trade with we're trying to make 1.5% for the week, To see this, we see this as a buy, 129.50. Now I'm using 129.50 as the worst possible high-end entry. Notice I'm doing that. I'm not giving us the low end, right below the low, buying on a limit. That's what you really would be doing. But I'm just giving you an example of using the highest potential area to be trading on a limit basis, buying at 129.50. Price would be down here. You'd be losing money initially. Do you understand that? Initially, you'd be underwater to the tune of about 15 pips. Now, knowing what you know now, that might not be that big of a deal. But before learning what I'm teaching you, you'd probably be squirming, wouldn't you? Oh, man, please don't hit my stop. Oh, man, please don't go down there. All of a sudden, you're a Christian. You're praying to God. Please let 129.35 stay intact. You're breaking up the Holy Mary cross and doing Hail Marys and everything else. Bottom line is, you're not thinking about the trade. You're hoping and praying. Now, I'm not saying praying is good, but in the scope of trade psychology, you need to focus on what's in the charts, okay? So if we see 129.50 as a limit buy, we defined our risk as 129.20. We have 30 pips exposure. So if we have a $1,000 account, okay, if we have a $1,000 account and we want to risk 1.5%, that's $15. Does everyone agree on that? Okay, so how many pips do we need if we do a gearing of 1-to-1? If we're gonna trade with 1.5% risk, with the expectation of making 1.5% risk reward, how many pips are we looking to make? 30 for 30, right? So what we need is from our entry, I'll zoom in. It'll become clear as I get tighter on this. Just give me a second. Let me flesh this out a little bit. If we're buying at 129.50, our stop's down here for 30 pips. From this price point here up to 29.80, that's 1-to-1 gearing. In other words, we risked 1-for-1 to be made as reward. So if we buy down here, even though we had about 15 pips drawdown, okay, if we can see a price movement up to 129.80, that's 1-to-1. Maria's asking a question. Let me hang on, folks. Don't say nothing real quick. But how can we have a $15 risk if we are risking 30 pips? Well, what's half? If you have $15 and you divide it by 30, what do you end up with in dollar terms? How much money would that be? 50 cents, right? Okay, so every pip, you'd be leveraging half of one micro lot. See, a standard lot would be $10 per pip. That's a standard lot. A micro lot would be $1 per pip. You're going to be trading half of. I shouldn't say micro. It's a mini lot. Mini lot, not micro. I'm not used to trading. I'm sorry. I apologize. You have a standard lot, which is $10 per pip. Then you have a mini lot, which is $1 per pip. Then you have a micro lot. So you'd be trading 5 micro lots or half of one mini. I hope I didn't confuse you there. But it's basically your leverage is going to be 50 cents per pip. Did I mess anybody up? Everybody following along? Only say if you don't. If I messed you up or confused you, say so. Okay, good. All right, okay. If we're trying to buy at 129.50 on a limit, okay, if we're trying to buy at 129.50, you would go into your trading account and do something like this. If you were watching price trade down there live at 129.50, you would do this. There you go. That's what you would be buying. Do you see that? You can't see the chart? Tim's saying he can't see the chart. All right. Does anybody else not see the chart? Okay. So this would be one standard lot. This would be 5 mini lots. And you would change the leveraging and gearing for this. This would be 50 cents. Can you see it? Yeah, Tim, if you can't see it, brother, I don't know what's going on. It'll be in the recording. I'm not sure why your connections. Try to close the webinar and come back to it. See if it works for you. I'll still be here when you come back. There you go. Thanks. So this would be 50 cents per pip. Okay? Do you understand that, Maria? Okay. So you'd be trading with that much gearing or leverage behind the trade. So every time it moves higher in your favor, you're going to make 50 cents. If it moves 30 pips, that's $15 profit. If it moves 30 pips below your entry at 129.50 and hits your stop, you incur a loss of 1.5% or $15. Okay. So now our first objective for 1-to-1 reward to risk would be 129.80. Okay. If we see 2-to-1, that puts us right above this old high. You see that? It may be a little difficult to see because of the coloring, but right here's where I'm highlighting that high. See that? So if we're buying down here, what did I teach you in regards to low liquidity, low resistance liquidity runs? Good grief. If we're buying, what are we aiming for? If we're buying, we're aiming for a previous high. Why? What's above those highs? Why is it high probability to see a buy run out a previous high? What's above those highs? Buy stops. That's going to be willing participants to take what off of your hands? Some of your longs. It makes perfect sense for you to be able to be a buyer, and you're going to find counterparties in the chart right before you even get up there. You're going to know they're going to be willing participants to buy it from you. So we are hunting liquidity above this old high. Okay, so we have an objective for 2-to-1 here. Now we're about to make a big step forward. Okay, the idea is we're buying at 129.50 with a stop at 129.20. Our risk is 1.5%. To get 1.5% profit, it goes to 129.80. We can move to a break even. We don't have any risk at that point. Why would that be good to trail your stop loss up to 129.50 once you get above your first threshold of profit? Once it trades above 129.80, what would you be thinking? You don't want to see it come down and give you a full stop, right? No, I'm not saying take first profit yet. We're not doing anything like that. I'm saying if we went long at 129.50 and we go above, once it trades through the first objective of 129.80, then we can start talking about moving our stop loss up. Because if it gets to 129.80, what is it showing us? It's showing us a willingness that it wants to go higher, right? So if it's going higher, if it's going up to 129.80, where's the liquidity at referenced at that price point here? If it gets to 129.80, where's the liquidity at? We've already came down and took these stops out below the low. So if it trades at 129.80, it's going to seek what? The liquidity above this old high back here. Okay? So we cannot trail our stop loss up at any capacity until we get our first price objective met, and it has to trade through it. It can't just touch it. It's got to go through it because it gives us willingness and shows us willingness that it wants to go higher. If it goes to that level, it's probably very high probability that it's going to reach for the liquidity above that high. Does it do it here on this candle? Look again, Ron. Does this candle trade through the 129.80 level? So now at this moment here, what can we do with our stop losses? Right now it's at 129.20. What can we do with the stop? You can move it to break even, yes. You can take something off and pay yourself. Or you can just move it up to the mean threshold. Or you can go just above the mean threshold, right below the bodies of these candles, not the wicks. So I'm going to ask you as a poll, what would all of you do given the situation, which you see in the charts right now? Where would you move your stop at? Everybody would be starting at 129.20, but where would all of you reasonably move your stop? Or would you? A lot of folks saying mean threshold. A lot of folks saying break even. Okay. Well, I'm gonna go with the majority. Everyone's saying break even. Okay. So we're gonna run our stop all the way up to 29.50. 129.50. Price is running up. Hits our first objective. What do you see there? You're watching price now. You jammed your stop all the way up to break even. What are you feeling? So yeah, all of a sudden you're like, oh, maybe I shouldn't have moved that stop so quickly. Do you remember what we talked about in the early portion of September, where I talked about managing your positions? You want to focus more of your attention and energy on where the market may reach for. Okay. So at this price point, right in here, when we see this down candle, admittedly, okay, be honest, I'm the only one that can see your responses here. Nobody else can see it. If you see that down candle like that, how many of you are thinking, let me make my stop lower again? So now here's my question to you. If you feel the willingness to want to move your stop down, does that indicate that you were premature about moving it higher? So where's your focus going to be? If you have your stop jammed up to break even, where's your focus going to be most heavily placed? Worrying about the losing or managing whether or not it shows signs that it wants to go higher? You're going to be monitoring the potential of the market hitting that stop versus studying the price action saying, okay, is price going to find support at this down candle? Because this is the last down candle before they see this up move here. So there should be some institutional support at this down candle, right? So if we see a little bit of retracement, that's okay. It's expected. Allow it. Institutional order flow allows price to retrace a little bit for new buying. Smart money does not buy on up candles, correct? Now, here's a big note-taking session, okay? If you buy something, you need to see the market trade away from the order block that it started to move, which is this down candle. It's the order block. Remember, who buys when the market trades down? Who's doing their buying when the market trades lower? Smart money, banks, okay? They have to do that because they won't get efficient pricing when the market's trading higher. So if we see the market run through here, if you're going to jam your stop up, okay, it still has to be below what point of that down candle? mean threshold, because price can still come down and trade a little bit into that candle and still be valid to go higher. So my question now is, for the stop from 129.20 being managed higher, where would you, knowing what I'm telling you now, where would you be reasonably safe and still efficiently trading this, but still lowering your risk? Below here? A lot of you are saying below the bodies of these candles in here. Is this what you're talking about? A lot of people saying yeah. A couple people saying middle of the down candle here too. But what's below these equal bodies here? The wicks only traded down there, right? So the bulk of the volume is here, and we've shown a willingness to go higher. And this is also above what? The base of this swing starts down here. This is the beginning point. So that order block here is what is the parent. This is what stems all of the buying from this level here, 129.34. The middle of that down candle, everything above that price point needs to be subordinate to this level here. So this is like the basic pivot point. When price moves away from that, anytime it creates a down candle, price needs to support it. We trade through this down candle to run the stops, and then we show willingness to be respecting this same level of mean threshold of this down candle. So we see willingness to buying here, but we now have this new bullish order block. So what is this order block relative to this order block? Is this order block subordinate, or should it support this buying candle over here, or should we expect this candle to be given up? It supports it. So if it's going to support the buying that was established here, the hierarchy is that this candle should not give up its ground. So in essence, it becomes a propulsion candle. It needs to propel price away from its parent. This establishes the order flow, this down candle. Why? Because price moves higher. We have an impulse price swing here. Price comes down, respects the initial order block here. The down candle, that means where all the buying originally started from. When it traded to it again, it showed willingness to support that idea. Why? Because price moved away quickly. Because it moves through that down candle, this is now a propulsion candle. This candle is not allowed to give up its mean threshold. It cannot do it. If it does, the trade is no good. It's no good. You cannot hold the trade any longer. You don't need it to trade down here, get close to your stop. You just know once the middle of this candle is giving up its ghost, it's over. Collapse the trade, wait for the next opportunity. If you don't listen to me and take that in your notes and use it in your charts, you're going to lose money, more than you need. What do I mean by, what does it mean by giving up? You don't want to see this down candle violated with price action going down below it. In other words, once this down candle forms and it supports the previous order block, you don't want this candle to give up the ground that it's building the idea of support. If price trades down through it, the idea is it's going to keep going lower. Does that make sense now? You don't want to see the middle of the body of the candle. That's the mean threshold. Think about the name I gave it. Mean threshold means that's the middle of the candle, and it's a threshold at which you do not want to see price go down below when it's a bullish order block, and you don't want to see price go above it on a bearish order block. So if this is a down candle, which is when we know smart money is buying, if the price trades up through it, the down candle needs to be divided in half. It's going to be supporting price from the middle point of that down candle up to its high. And you want to see price be sensitive to that. And you do not want to see it trade down below 129.50. And in this case, you don't want to see your trade ever trade down to a losing position again. If it does, probability shift to very, very unlikely. So now, my question is if you know you're in at 129.50, and your stop originated at 129.20, and you see this price action here, do you want to jam your stop up to break even? No, you don't. You don't want to do that. You do want to reduce the risk. So you can go up to this price point here, 129.34, because it's highly unlikely it's going to get back down to that level. And if it does, you don't want to be in the trade. You want to have your stop loss in an area where it's economical and just good business for you to be out of the trade at that point. Not, I'm willing to take this as a maximum loss. That's not how we as professional traders use stop loss orders. The stop is at a level where you want to be wrong. You know you're wrong on the trade idea, and it has the least impact on equity. Does that make sense? Your stop would be at 129.34 or 129.35 rather, I'm sorry. And it's because it's the middle of this down candle right here. That's where all the parent institutional order flow stems from, this down candle here. So your stop goes from 129.20 to 129.35. You've trimmed half of the risk off. So now you're only trading 0.75 of 1%, 3/4 of 1% risk. The market had created one little down candle here. We want to watch. This is where you would have been buying. You want to be watching this now. As you watch the trade pan out, you want to see sensitivity. If it dips down in there, you do not want to see it go down below 129.50, because then you got to start worrying about whether or not you want to keep that stop. The next candle, what does it do? Uh-oh. What is this? The low is what? 129.50. Some of you might have got knocked out. See that? So we're watching this down candle. We don't want to see it lose 129.50. Okay? What's this candle now support? What is it showing us? We had a down candle here. What do we do now with this down candle? We start monitoring whether or not this down candle supports price going higher. Institutional order flow, your reference point now is this one. It's now a down candle. So if we see higher pricing, then we know that they bought down in this down candle. How about this candle? Does it support your idea of looking for higher prices? How about that? Okay, so when you're watching trades pan out, the way you're managing your trade, you got to keep in context what you framed the trade around initially. What was the beginning basis point? It's this down candle. We had an impulse price leg. It retraces down, clears out some stops. Our limit order was the worst possible entry for a long, which is 129.50. It's the highest end. It could have been a little bit lower. It could have been below the lows over here. 129.45 could have been. So using this idea, when we're watching price, this is 2-to-1 reward to risk. Buying at 129.50, getting out with a move above the old high here. $130.40. There's 3-to-1 right there. So if you risked 1.5% buying at 129.50 and price goes up to 130.50, it's 100 pips. What did you actually make? 3-to-1. So what's 3 times 1.5%? That's 4.5% on one trade. One trade. You're not looking for a million trades. You're looking just for one setup that you manage and you watch, and you don't care about anything except for that one trade. Now think about this. Remember I was asking you about this candle here, and when it trades through it here, all the institutional focus is on what candle? This one, right? Remember I told you when we saw this candle here trade down and it trades up through it, all of your attention goes onto this candle right here. What just took place over here? What are you seeing? You see that? What's actually happening in here? Exactly. It's reaccumulation. They're recapitalizing a bullish order block. Do you think there was some buying in here? So what am I highlighting here? Look at the bodies of the candles. See how the wicks dip down into that candle here. They're dipping down into that candle, absorbing more what? What's below this low? I was asking you a question earlier when we first started this trade idea as an example. Everybody's really quick to do what with their stop loss? Move it up. Move it on up and jam on it. You can't do that. You have to allow institutional order flow to indicate when it's probable for you to move your stop up. When we're looking at a bullish move, where is all your focus? Down candles. Because the down candles are going to do what? It's going to highlight what? Where the institutional buying is. It's not support resistance lines, okay? You need to be focusing on the down candles when order flow is suggested to go higher. In other words, if the trend, if you want to say it like that, if the trend is moving higher, if you think it's going to be higher, if you look at all your price charts, and this is exactly what I want you to do because you're going to find out by the end of this week how many opportunities there are for you to easily do 6% every single month. This is just one trade idea, okay? And believe me, I'm going to use even less favorable conditions and show you how it's very easy. And in fact, we're going to do 1.5% live this week. I'm going to do a trade. I'm going to outline the whole thing. We're going to do it live in here so we can see it. And we're going to do this every single week of the entire month of October. And I'm going to show you, framing it, how 6% is absolutely easy. You're going to know why I'm doing it, where the stop's going to be, where we move, all that stuff. You're going to see all this stuff before it happens and explain it to you, okay? But conceptually, everything I'm showing you here is everything that we leaded you into in the first month. So if we have an expectation that we wanted to be a buyer down here, relative to the swing that was here to here, let me take all this business off now. Okay, so impulse price swing was from this low up to this high. Why is that important? Because it broke market structure on the upside, right over here. We reference old lows. Was that not in your first month's teachings? Find your old lows. What's going to be a below an old low? A liquidity pool. That liquidity pool houses or contains what? What's underneath an old low? Sell stop or selling liquidity. If the market goes down below an old low and we think the market's going higher institutionally, our assumptions are immediately, if a low is being violated, what trading pattern is this? Alan already knew what I was going to say before I said it. See that? Your anticipatory skills are already going on now. Awesome. So you're thinking that anything below this low, that's a buying opportunity. Retail's not going to think this. They're going to think this is support broken. It's going lower because they're going to see this as tweezers, high, a false breakout. I guarantee if I pull out some kind of an indicator, it's probably going to give me some kind of a bearish divergence in here. Let me just do it because I like doing that kind of stuff. I like beating up on what I used to believe in. I used to believe this crap. I'm telling you, it's crazy. All right, so here's your higher high, and look at these indicators right here. This is absolutely a sell. Look at that. Right here, look at that. Is that not a classic textbook Bearish sell. I'm all over that. That's obviously one of those bearish wombat patterns. It's a harmonic bearish wombat. Okay, and what you want to do is you want to sell short here and use your, well, I don't know where your stop would be, but the wombats are really high probability, so you can just get short there and just wait for 1,000 pips and everything will be great. But the problem is that's not what happens. Okay, the problem is that does not occur like that. Indicators are just going to put you on the wrong side at the most inopportune time. They want they want you to think when the price is going below an old low that that's a break in support, so therefore it's going to be an indication you're going to see lower pricing, and it's not. It's only going down to take out the selling side of the marketplace. Okay, so when you understand institutional order flow, you're looking for, obviously, indications that they want to take the price higher. How do we know that? It has to take out a previous high. Okay, and if you can frame something down here on an institutional basis that supports price going higher, you wait. You're not waiting for some neon sign, okay, or some voice from the heavens to speak to you and say, hey, look, it's time to buy. You're waiting for price to break through a previous swing high. When it does that, we have an impulse price lag. You wait for price to go below equilibrium, and if you can couple it with an old low, that's a loaded deal. You know they're going to take price down here, take the liquidity out, and then you watch price go higher, and you every time it creates a new down candle, you monitor how much sensitivity there is in that candle. Look at this. It's obvious, isn't it? Now, for those that just started, that didn't get a chance to watch all the videos on a day-to-day basis where we were talking about moves before the fact, going to specific levels and all that stuff, this is going to feel like, well, this is the same old hindsight crap. There's hindsight in this teaching. It has to be. Otherwise, you're never going to learn what I'm talking about. But it's consistent. It happens every single trading day. But if you don't see these things conceptually taught to you, you're not going to understand why I'm explaining it to you in just a few examples I'm going to show you over the course of this month. It needs to be seen in your chart studying it, okay? So 4.5% payout just on one trade. So if you have an objective that you're trying to make 1.5% return, all you needed to do is see 129.80 to pay that, which was down here from your buying down here. That right there is your 1.5%. It did that in 2 hours, 3 hours if you want to count the down move here. So inside of 2.5, 3 hours, you've made your 1.5% for the week. And look how much movement was there. Was that a lot? How much time were you in the marketplace to make that 1.5%? Not long at all. Not long at all. So if we understand, excuse me, if we understand that this is a phenomenon that repeats itself over and over and over again, okay? If we wait for opportunities, market makes a high, okay? What happens here? Market trades down, it blows through an old low. Well, what does that mean? Institutional order flow is now shifted to the downside. So we can now do what? Wait. We hurry up and wait. We have a high down to this low. Why am I picking this low? Because this is the one that starts seeing the price moving higher. All these lows in here are all used in the time that they form, but it never gets above equilibrium. And I'll show you what I mean by that. As price makes each one of these new lows from this price swing down, after it breaks these lows over here, price expands lower. Does equilibrium get traded to from this low here? No, it just keeps going lower. So you keep moving your fib to the next level. Does it get up to equilibrium here? Not on that low. It goes lower. How about this low here? It goes up through equilibrium. It goes right up to what? What is this? What is that? Is that a discount or a premium? It's at a premium. We sell at premiums. We want to sell it at a high price with the expectation of buying it back at a discount, and we capture the difference in between. So if we are looking at this retracement here, okay, price trades up to here, what would we reasonably expect to see in terms of where your stop would be? If you wanted to be a seller up here, we're just going to say you sold it right at the 62% retracement level. That's the bottom of this up candle in here. It's inside the bulk of this wick on this up candle here. So there's a lot of selling indications in that area right there. So you can look to be a seller and have a stop, what, above here? Where your stop would be, above this, above here? Some of you took the bait on that. Your stop loss would be above here, right? Is that what you're saying? If you wanted to sell down here, your stop's up here. What's this candle right here, this up one? This last up candle right before the move down. What does this up candle indicate? It's the bearish order block. Who sells in up moves? Banks, institutions, smart money. So right above the middle of this candle is where your stop would be. And we'll just round it to near 5 level. Okay, so 130.45 above the mean threshold of this up candle. Plus you have defense above any run on these equal highs. So if you get short here, I don't know what that price is. This thing's in my way. Say you sold short at 130.15 or 130.10. 130.10, nice round number. Okay, may have had about 10 pips drawdown as it ran in through that level. Okay, so you have to have a stop of 130.45, selling at 130.10. So how much is your stop in terms of pips? 35 pips. Wait a minute, Michael. Wait a minute. You said 30 pips is the average stop. Yeah, it is. That's the average. You want to have trades that give you about a 30 pip stop if you're trading on an intraday basis and you're trading a daily range. 30 pips is about right. But we're trading swing trades. These are intraday swing trades. So you're going to have to frame it on what the institutional order flow is giving you. So if you're locking your limit to only taking trades with 30 pips, you're going to miss some opportunities. Okay? So in here, we have a 35 pip stop. So if we have 35 pips, there's your 35 pip stop. From that point on, lower, there's your 1-to-1 right there. If it gets down to this price point here, you've already made 1-to-1. Now, forget that. Don't count the money. Institutional and order flow wise, if we're selling here, okay, and it's at a premium, where are you looking for price to go and why? At this price point here, obviously it's in your charts, but I'm saying specifically, conceptually, where's institutional order flow going to seek liquidity at next? Awesome, awesome. Below this low, right? Now think, what else is on this chart? Keep going over to the left. What do you see? Ben already saw it. What's down here? What's below these equal lows? Candy land. All kinds of sell stops below there. So if the market wants to be sold at a premium, where's the most logical area where they're going to have the biggest injection of willing participants to sell to? Because they have to buy it back. If you're short, to get out of your short position, you have to do what? You got to buy it back. So you have to have participants to be willing to do what? Sell it to you. So the institutional perspective is the bank is the bank is the supply house. They are always on the sell side of the marketplace. So they have to engineer, and you tell me if this is not true, you're going to see more double bottoms form in price action than there are double tops. And the reason why is because they have to engineer liquidity in the form of putting suggestions into price action that this is a support level. Because the normal capacity of delivery of price is that the central bank is the supplier. They provide the sell side of the marketplace all the time. They're the liquidity provider. So they have to engineer willing participants on the fund level to be counterparties at the sell side. That way, when they're going short, they have to have folks believing that there's a reason to put a sell stop below there. And then when price reaches for that level, those orders become what? Sell orders at the market, which is where the market makers pair up their orders on shorts to cover or buy back from those willing participants to sell at. Do you understand it now? So if we understand that, this is where we're selling, and we've outlined our stop here. If we're aiming using institutional order flow, one, two, three. 3 to 1, a run on these stops right here, right on that candle at 129.05, whatever it is. Okay, there's your 3 to 1. So if you're risking 1.5%, selling here with a stop here, all we did was reverse the idea we used over here, just on a sell. This is where you would reach for liquidity. The market should expand down, not to just any old level, okay? Not the flying squirrel pattern. It's going to go where the liquidity is, right below these lows. Look at the expansion. See that? So in the span of 1 week, or the course of what would be equivalent to 1 week, or really just 3 days, 3 days trading, that's 9% return. Right? So my question is this. If you have low objectives, which is what we're talking about over here, 6% per month, start there. You have to have a target. If this is not a good target to start with, I would tell you. But it is. It's a good target. Everybody does what with their trading? They all risk 2%. Sometimes trade more than that. But if you can't make a trade that pays that same amount of risk, why are you putting the trade on? So if we can frame a trade that pays us 1.5%, and obviously we've seen very little is necessary to make that. See, the folks that tell you don't have these targets, don't have a weekly objective because you don't know what the market's going to give you. That is a load of crap. That's coming from somebody that has no idea what they're talking about. They have no idea how to be consistent. They aren't making money, okay? They're only talking to you from a myopic stance that they have not been able to do it themselves. So therefore, everybody else has to be forced in that same equation. You can't do it either because I can't. I'm telling you, you can. You absolutely can do this. And now look, did I switch pairs? Did I go to a different pair? We stayed in one currency pair, right? Did I change time frames? You do not need 50 friggin' pairs. You don't need 5. You don't need 20, okay? You just need 1. If you understand what price is telling you relative to premium or discount, where are we at in institutional order flow? Are we above an old high or below an old low? Where's price suggesting it's going to go? Where is it supporting? If price is moving higher, every down candle should be supported. Now watch what happens. We have this down candle here. Price went through that and it hit our objective. We still have to consider this because it has not been traded to again until here. Then we see the price expand. Now we have to watch this down candle. Price stays above it. We create another down candle here. Price goes through it. So I have to watch this candle here. Look what happens right there. What just took place on this candle right here relative to this one? It consumed its body after an expansive price action here. This quick run up, when we see this down candle give up the ghost or go lower right here on this candle here, this body is consumed. So what can we reasonably expect this market action right here to be? What was this price action in here? What was going on in there? It cleared out all these equal highs. Okay? And price does what? It trades softer. In fact, if you go back here and look at it, that's the level that we already noted before. We talked about this before it ever even went there. Before it even went there, we talked about that level. So here it is here, panning out in the chart, and it gives you evidence to support the idea that institutional order flow is now shifting. The down candle should be supporting price. It's not happening here. And then I watch this down candle here, right before this up move. What's occurring over here? It eats right through that. So now what do we have? Institutional order flow is shifted to what side of the marketplace? Is it still bullish? It's bearish. So now all you do is you wait. You start drawing your fib from your high down to your low and wait for it to go above equilibrium. If it does, then you start hunting optimal trade entries coupled with turtle soup sells or bearish order blocks. It's that simple. And you're going to see this pan out every single day the rest of this week. We're going to talk about examples in hindsight, and I'm going to share with one before I even do anything with it. I'm going to outline everything and why I'm doing it. And you're going to see it unfold, okay? But I want you to understand that it's not hard to do this 6% over here. It's not hard to do that at all. And if you do this, if you start with the 6% model, it's easy to expand on that. See, that's my point. If you sold here with your risk defined here, you only need profits to get down to this level here. That's it. In 1 hour, you've already made profit. Sorry about that. Had to put the dad hat on here for a minute. So if you're selling short here and you're trying to make that that 1.5% for the week, as soon as you get down to this level here, you've already hit it. You've already hit that. So the notes for September will be delivered at 9 p.m. Check the thread. I already updated that last night and told everybody through the thread. So even if you weren't aiming for these lows over here, just this old low running out, those stops below that low right there, that's enough as well. That's more than 2 to 1. So again, if you're making 1.5% risk model and you're trying to make 1 to 1 gearing, you make 1.5% on this move here. And if it gets 2 to 1, you're making 3% right there. Now check this out. Say it never, ever, ever gets down to your 3 to 1 and it gives you just 2 to 1. And you live in 2 to 1 payouts. You're making over 12% a month. Correct? You guys fall asleep on me? If you have a $1,000 account and you make your bread and butter setups 2 to 1, your $1,000 becomes $3,895 in the course of 1 year. In 12 months, your $1,000 over here, if you're making 12%, in other words, you're getting 3% per week. Okay? Your account grows to $3,895. That's over 300% return, almost 400% return. So now, if you can get this model to 3 to 1, you're making 18% plus a week. I'm sorry, a month, a week. Listen to me. So if you have $1,000 and you only live in 3 to 1 setups, your $1,000 account becomes $7,287 a year in 1 year. And if you live there, in 2 years, at the end of 2 years, not taking any account for taxation, you end up with $53,000. So what do you think about that? So here's your homework for the rest of today, and as we go through the rest of this week. I want you to go through the charts, and using what we've only shown so far for the first month, okay, only using that information and what I've outlined in terms of managing trades and looking at institutional order flow. As the market moves higher, you want to look at the down candle supporting price. When you look at price like this, okay, I want you to go through your charts and realistically go through just one currency pair. Whatever currency pair you picked for the beginning of this mentorship, you want to understand that one pair intimately. And if you go into the price action, like we're showing you here, it will give you a plethora of examples every single week. There's an opportunity for you to do this. And I want you to just reasonably aim for 3-to-1, okay? Look for 3-to-1 conditions, and you see how often they pan out. Looking for them in hindsight builds your understanding of what they look like. So that way when you start seeing them in real time, you'll know when I'm talking about a specific setup, you'll be in agreement with why I believe it's there. The last thing I want is for me to talk about how, if you hear me say, this is a low resistance liquidity run, I want you to know 100% that that's a trade I have money in. And I'm not going to tell you anything beyond what I just said there. It's not an invitation. It's not, come on, jump on my back and let's do the same thing. I'm indicating that I'm in a trade. So if I'm telling you I'm in a trade, that means I view this as the highest probable setup for right now with the least amount of risk, and therefore you'll know what to look at and why I believe that, because you've seen enough of it in your own study. Does that make sense? Okay, I'm going to close this session for today. We've been at, well, 2 hours now. That's not what I want to do on a daily basis. I want to make them a little bit more streamlined, but this is the beginning of the new month, so I want to give you some content to work with, get your gears going, and show you how much consistency the things that we've already showed just in the first month still are applicable, and we're going to build on this every single month. There's going to be something added to it, okay? But I'm going to end up talking my voice away, and I won't be able to speak to you tomorrow if I don't watch out. So I'm going to close this one. I'm going to wish you a very pleasant afternoon. Good luck and good trading, and study. Go into your charts. Don't be fearful about these little objectives over here in terms of profitability. And don't listen to people that say don't make targets, because targets are easy. If you don't have a target, why are you trading? Every trader out there has a target. You have to, or otherwise you don't know what you're aiming for. So with that, have yourself a very, very pleasant afternoon. I will get back with you all this evening. I'll send you a recap, and I'll post this video. Right now it's 10 o'clock in the morning New York time. Give me till 11 o'clock because I still have to feed my little ones. It's the Jewish holiday today, so they're closed with school. So I have to feed these little munchkins, and then I'll get back with you and upload the video. So if you missed it or came in late, you'll see it all in about an hour, okay? Have a good afternoon.